Olá, o meu nome é Miguel Rego e estou aqui da parte da FundsPeople para dar as boas-vindas ao podcast com o tema O papel das obrigações no atual contexto de mercado. Rita Gonzalez, partner de investimentos na sociedade de consultoria para investimento Baluarte Wealth Advisors, vai estar à conversa com Nicolas Trindade, gestor do AXA World Funds Global Short Duration Bonds da AXA Investment Managers. A conversa será em inglês e esperemos que seja do vosso interesse. And now the word goes to Rita and Nicolas.
Hi. First of all, thank you very much for the opportunity to have this conversation on such a complex moment. I believe that the main questions that we all have regarding what is happening, it's of course the idea that we have a very complex duality of factors. First, we do know that we have data that is indicating that we are going through a new cycle of slowdown in growth. But then we also have, of course, all the continuing inflation pressures. Then we have the worsening of the pandemic. And of course, everyone is just looking for what will authorities really do at the moment, which is quite complex as referred. So what we have seen from their speeches is that they are starting to get less tolerant towards all the inflation data that we have been reading. So first of all, I believe that for fixed income and for financial markets as a whole, maybe the expectation through what policy makers and monetary policy in particular, but of course also fiscal, what do you think that on the current environment should we expect from them?
Yes, thank you for having me. So definitely, going into 2022, we definitely see two main risks. The first one is around COVID and the potential new variant that will be a lot more transmissible and potentially could evade the current vaccines. And actually, we got some negative news from that perspective this morning with the new South African variant that we can maybe talk about a bit later on. Then the second main risk that we see to the outlook is inflation. Inflation has definitely surprised on the upside. If you would have talked to economists at the beginning of the year, they would all have thought that CPI would be at 2% by now, which is definitely not the case. So inflation has definitely surprised on the upside. And that's something that we need to be really mindful going into 2022. I think central banks are becoming more and more uneasy about those high levels of inflation. And what we may see is actually, for example, in the US, a faster tapering. And we may see a tapering that instead of ending in June 2022, may finish as early as March 2022, enabling them to hike interest rates a bit earlier in 2022. So definitely, I think the risk going into next year is definitely for faster tightening and higher and faster interest rate rises.
Yeah, but don't you think that the pandemic situation worsening will just maybe change the expectations on what will really do the monetary authorities? Because of course it's a great threat in terms of the economic growth that actually is now slowing down.
Yes, the issue we have is that obviously we don't know a lot about the South African variant as it is today. We think that it's more transmissible, but we're not really sure if if vaccines are still, capable of handling it or not. So we lack clarity here. And I know that a lot of scientists is going to be looking at your new strain of COVID-19 to assess that. Now, obviously, if this new strain that we've seen in South Africa can evade vaccines, or if, for example, it's a lot more transmissible and people get a lot sicker when they contract that virus, then obviously what we may see is a return of lockdowns. Mm-hmm. And what we may see is basically a slowdown in economic activity because of that. Now we can hope that, Pfizer, AstraZeneca would be able to come up with a new vaccine that could deal with this new strain, but obviously it may take time. And so if you take the view that we're going to go into lockdowns again by the end of this year, then very clearly that push out basically any interest rate hikes.
Yeah, and it's already happening at Central Europe. We have many countries that already imposed lockdowns.
Yeah, I mean, we have some countries like, for example, Austria, who decided to put a 2-week lockdown on its economy. Again, the market to some extent discarded that because Austria, obviously, it's a small economy within the context of Europe. And I think most of the focus really is on France and Germany in particular. And cases has been going up quite dramatically in Germany. But I think there's not a lot of appetite, to be honest, to go back into lockdowns. And I think they will try to do other things before having to go into lockdowns. I think lockdowns end up being really the last resort action that governments are really willing to take. But again, we were always expecting some kind of a winter wave coming through, and I think we are right in the middle of it. But everything being equal, if you look at a central scenario, and if you talk to our US economists, what he would expect is basically for tapering to end in June 2022, and for the first hike to be in December 2022, and then to see another 3 hikes in 2023. That is the central scenario. Now, from our perspective, assuming everything is fine on the COVID front, the risk is probably for a faster taper and an earlier increase in interest rates. So that is for the US. If we focus on the Eurozone is in a totally different situation because we expect QE to go all the way to basically the end of 2022. And we only expect a first hike in interest rate in the second half of 2023. So monetary policy conditions are still going to remain very easy in the Eurozone for the foreseeable future.
And given that scenario and the main subclasses for fixed income regarding government, investment grade, high yield, corporate generally, and emerging markets, do you have a view where we can find more value, or do you have any expectations or reference goals in terms of what would be the objectives we can have and the performance we can have on the short term or on the medium term for fixed income?
To be honest with you, I mean, it's difficult to find value right now in fixed income markets because everything looks quite expensive. I mean, if you look at investment grade markets, they still look really expensive from an historical perspective. If you look at higher, they look a bit cheaper, and they definitely underperformed over the last month and so. And here there's maybe a little bit more value, but again, from an historical perspective, it still looks quite expensive. And then EM is facing his own issues. I mean, EM is facing the issue that comes with China. We're seeing a slowdown in economic growth in China due to the slowdown in the property sector. Then a lot of emerging countries are faced with higher inflation, and a lot of EM central banks have had to hike interest rate this year. So it's quite a challenging environment for EM. And that's why since the beginning of the year, we've been actually reducing our exposure to EM countries because we think the current environment is quite challenging because they face the pressure of higher inflation, which leads to higher interest rates. Then on top of that, the Fed is tapering quantitative easing, and we expect to see higher treasury yields and higher interest rates. So that is quite a challenging environment for EM countries. The portfolio that I manage, the global short duration portfolio, is flexible in nature because we can invest in sovereign, investment grade, high yield and emerging markets. And we invest up to 5 years maturity. That's why it's a short duration fund, because we have a cap at 5 years. And if you look at the portfolio right now, we are overweight govies. And actually half of our govie exposure is in linkers. We are quite substantially underweight investment grade credit, and we are about neutral high yield and EM. And the reason we position this way is because I think in the current environment, it's important to still have a good bucket, a good defensive bucket within your portfolio, because that gives you the ability to re-risk the portfolio if you see attractive opportunities. And having a lot of linkers also, I think, is quite attractive in the current environment, considering all the upside surprises that we've seen on inflation. Then being underweight investment grade makes a lot of sense because firstly, as I said, valuations are very expensive. And secondly, the investment grade market tend to be quite long duration in nature. And so technicals could potentially be quite negative for the investment grade market overall. And then finally, we are still neutral on high yield in particular. And the reason for that is because we want to optimize the carry within the portfolio. In a low spread, low yield environment, you don't necessarily want to be massively underweight high carry asset classes, because otherwise that could have an impact on your performance in an environment where spreads don't move much.
So yeah, so Fixed income is, of course, one of the main areas of any diversified portfolio. All the financial market seems to be quite expensive, not only on the fixed income side, but also on the equity side. Many analysts and many managers just are looking at the moment for the real rates, and if we keep up with such low and negative real rates, many of them think that we can have value still on the equity market. For this, and given your view on the market, which is of course with a low return potential, what is, in your opinion, the diversification power of the fixed income area on a diversified portfolio? What I mean is that at the moment where we will have positive correlation between rates and equity market, where do you think we can have really diversification power for the portfolios?
I think if you just look at today, Black Friday, I mean, I think fixed income market has shown that you can benefit from diversification by being in fixed income market, because if you look at the yield of the 10-year treasury, it's down 10 basis points. If you look at the yield of the 10-year gilt, it's also 10 basis points. It probably runs 6-7 basis points for the 10-year German bond. So again, you can see here the benefit of diversification, because in a risk-off environment, you will have government bond yields basically falling, and then you will benefit from capital appreciation from your government bond exposure in the portfolio. Now, obviously, the issue we face is that if we focus, for example, on the Eurozone, the absolute level of yield is minimal and even negative. So there's only so much that basically German bonds can rally in a very difficult environment. But now, if you take the view that the environment is going to be difficult and we're going to have a market sell-off, what you want exposure to is US Treasuries. Because if you look at the yield of the 10-year Treasury, it's still 1.5%, even after today's drop in yield. And so there's a lot more room for Treasuries to fall and basically provide the real buffer versus a fall in equities, for example. And that's why I think having a flexible strategy is very important, because a flexible strategy enables you to allocate where you see the most value. Because if I was running a pure Euro fund, all I would be able to do is buy bonds basically for defensiveness. And that in the current environment, it doesn't work as well as an hedge at treasuries. And that's why having a flexible portfolio when you can invest in different parts of the market, I think is definitely optimal in this type of environment.
And regarding the credit and what happened on the last year, the liquidity profile, and given that we have such a pressure on the market, do you think that if we do have a moment of uptrend on volatility, can we at the moment have something that is similar with what happened with a possible crunch on the credit side, on the liquidity profile?
Yes, I mean, but potentially that's something that you could see. I mean, going back to March 2020, I mean, I remember being in the market and trying to sell some AA rated banks, and I could sell them, but at the price that I wasn't really happy with. And very clearly, we see a liquidity crunch. To be fair, it was less worse than what we had back in 2008, but still, it was very difficult to trade. And that's one reason why, when this time around, we decided basically to increase the defensiveness of the portfolio. What we've done is increase our exposure to govies, because that is the ultimate risk-free asset that you can easily trade even in a different market condition. So yes, I mean, let's put it this way. If the South African variant is a lot more transmissible, it can evade vaccines, where we can probably have quite a big market downturn on the back of that, until the market understands what are the near and medium-term implications, and you could see a drop in liquidity. Also, you have to remember that we are at the end of the year. As we say, we are now between the two turkeys, between Thanksgiving and Christmas, and liquidity tends to drop quite a lot. And that's why that, the movements we see today on Black Friday are probably also exaggerated by the fact that the US is mostly up today. But no, definitely liquidity is something that we always have at the top of our mind. And that's why I think a global short duration product is very powerful from that perspective. Because if you look at the portfolio right now, 80% of the portfolio matures within the next 3 years. So it's got a very natural, strong liquidity profile. And that can make a really big difference in very stressed market conditions.
And regarding the moment and what we are looking in terms of the pressure all the managers have on the ESG approach and all the green approach that are imposed to the portfolio. How do you think, how do you look at the market in terms of sustainable and environment, and where do you think that value? Don't you think that we are beginning to have saturated niche on the portfolio that could harm the whole market in terms of what can happen if we have more volatility and some areas of the market that seem to be quite expensive and can have pressure where the liquidity will not help?
Yeah, I mean, if you look at the green market, I mean, we've definitely seen a lot more issuance of green bonds or social bonds over the last year, and even governments that have started to issue, green bonds. And for example, the UK has done quite a big issuance a month ago, I think. So again, we've seen more and more issuance of green bonds. Now, obviously, you also need to be mindful of valuations, and actually, quite interestingly, green bonds tend to be more expensive than the equivalent non-green bond. So if you look at an issuer, and if you look at a green bond, non-green bond, same maturity, same underlying credit risk, usually the green bond tends to be more expensive. And the reason why is because there's strong technicals. There's a lot of demand behind those green bonds. So again, the view we have is that, yes, we want to participate in green bonds, but not at any cost. If we believe that, it doesn't make sense from a valuation perspective, then we won't participate into the green bond. Because again, it's not a green bond fund that I run. So we have this flexibility to pick green or non-green if needs be. But I think ESG comes further than just green or green bonds. And the way we do ESG at AXA IM is that it's fully embedded within our credit research. So our credit analysts, when they look at the fundamentals of the company, will also take into account the environmental, social, and governance aspects of the company. And those aspects could potentially lead to a downgrade of the fundamental score of a company if we believe that could have an issue for those particular companies. So we do it at the credit research level, but we also do it within the portfolio. So we have sector exclusions that are linked to ESG considerations. And we also target an ESG score on the fund that is higher than the ESG score of the benchmark. So again, I mean, we like to believe at AXA IM that we are really a market leader when it comes to ESG, but it comes in different ways. And I think one last point maybe to make on this one, engagement is very important. And again, that's something also that we do quite a lot, because it's not only about excluding companies, it's also about engaging with companies to try to make them better. And that is something that we've been doing a lot.
Yeah, so ESG is something that, of course, gives us a very relevant perception of what to do, but this changes in terms of the value of some areas that don't have the depth they need to have the liquidity for a moment with the volatility just increasing. I believe that most probably will harm many investors if we have a really difficult moment in terms of what will happen on fixed income market, because they seem quite expensive. Yeah.
Yes, I mean, as you mentioned, they're very expensive. And the other thing to bear in mind is that some sectors are structurally cheaper now. So I'm thinking, because some sectors from an ESG perspective tend to be overlooked by investors. I'm thinking about tobacco, I'm thinking about mining, I'm thinking about oil and gas sectors. All those sectors from an ESG perspective tend to be overlooked. And that means that structurally those sectors are just cheaper than the rest of the market because there's less demand for it. And that's why engagement is very important, because we don't believe in just pure exclusions. I mean, we need oil, we need gas, particularly during the winter. So, we need to heat our houses, and we still need to be able to go to work. So, we just cannot blind our eyes and say we don't need oil or gas producers. That's not true. We need them. But what we need to do is talk to them and try to have them move towards net zero by 2050. Now, obviously, if we engage with them, if those companies are not willing to move toward net zero, then that's at this point that we start disinvesting.
And on the currencies, do you have any view on, for instance, for the dollar? Do you think that it will continue its strength based on the expectations of what will happen in terms of the rates and all the financial market?
Yeah, I think what we could see is an environment where the dollar could keep on appreciating, because very clearly, particularly versus the euro, because as we discussed earlier on, I mean, we don't expect the ECB to hike interest rates before the second half of 2023, which is a really long way off, when the Fed is probably going to be hiking at least once next year and probably 3 times the year after. So definitely what we could see is still quite a good strength, particularly of the dollar versus the euros over the short to medium term. That is something definitely to bear in mind. So now when it comes to the product that I manage, we don't really take currency views because it's a short duration portfolio. And if we're starting to take currency views, that will overwhelm the performance of anything else we do. So we hedge currency. But I think one thing that is very important to bear in mind is that you can see dislocation across markets, because most issuers issue in several currencies. And what you can see is a bond from an issuer in what currency can trade a lot cheaper versus another currency. And because we are global investors, we can buy euros, dollars, and sterling. What we try to do is get access to the issuers in the cheapest currency. And sometimes you can have quite a big delta between 2 currencies for the same issuer, in which case we try to benefit from it because we just arbitrage the difference.
And now regarding such more specific on Asia, we do know that Asian bonds and namely high yield were one of the most popular asset classes at the beginning of the year. There was so everyone was and still thinks that there is a lot of value given all the analysts that we look to. Most of them say that Asia is actually the cheapest area on the globe in terms of the potential it has. What's your opinion on that? Do you think that all what's happening on the real estate, Evergrande, everything, do you think that in such a complex moment at the market as a whole, with a lot of uncertainty, do you think that Asia, it's really an opportunity?
So I mean, if you look at Asia, and obviously a big chunk of Asia high yield is Chinese high yield, and a big proportion of Chinese high yield is Chinese high yield property. And very clearly, so what has been happening is that the Chinese authorities have been basically pushing property companies in China to deleverage. They went through the free line, red line policy, and they've been pushing quite hard property companies to deliver. And that obviously has created a lot of issue for a lot of property companies that were using the offshore market, so dollar funding, to be able basically to keep on growing. And we've started to see a couple of defaults coming through. And obviously, so some of those names have been dropping like stones. I mean, because we have an Asia team that is based in Hong Kong that manages that kind of portfolio, and we talk to them on a regular basis. And some of the bonds were trading at par midsummer, and now they trade in the 30s, 40s. And if you look at the overall sector, it's been extremely challenging. And I think what is difficult is differentiate across companies, particularly in the single B space, because it's really headline driven and liquidity is not great. So you could have a negative headline and the bond will drop basically 20 points. So I think right now, looking at the Asia high yield property, I mean, Chinese high yield property sector, I think there's definitely a lot of value, but there's also a lot of risk. And having the name selection right, I think is quite challenging in the current environment. Now, what is quite amazing is that there hasn't been any contagion to investment grade market. So if you look at Chinese high yield, I mean, I think at some point we got to yields of 30% when Chinese investment grade barely moved.
True.
And I think the reason for that is because there's a strong belief from the market that Chinese authorities will intervene if you started to see some contagion out of Chinese high yield property into Chinese investment grade market. but so far there hasn't been any contagion. So yes, there's definitely a lot of value, but there are a lot of risk, and the volatility is massive. I mean, we're talking about bonds moving 10, 15 pounds a day. So you have to be prepared to take that kind of volatility on.
Yeah, because as you have said in your introduction, the market is expensive. That then we have these areas where we do think that maybe there's value, but if we have a crunch, it will not help at all on the diversification.
No.
So.
No.
In terms of your approach, given the importance of the flexible approaches on the fixed income portfolios, in the yield up trend and increase of volatility, which in your opinion are the main tools you have just to deal with it?
Yes, I think that in an environment where you expect interest rates to increase and you expect yields to rise, in the fixed income space, you want to be short duration. So you want to have a low duration. I think that's the first thing, because that will help you mitigate the impact on capital from an increase in interest rates or in yields. I think you also need the flexibility to be able to allocate to the asset classes that you think will provide you with the better return according to the outlook that you have. So I think flexibility is also very important. But again, I mean, 2022, I think, is going to be definitely more challenging than 2021 was. We started to have a bit of rates volatility towards, for most of 2021, to be fair. And we started to have credit volatility over the last couple of weeks. And I think it's just a preview of what we're going to be experiencing in 2022. So if I was having one recommendation for 2022 would be basically to lower your credit risk within your portfolio. Because valuation is very tight, and I don't think it's worth overextending yourself in this type of environment. And I will also move towards, short duration again to try to mitigate the negative impact of rising yields. That's why we think that the global short duration fund is quite a good opportunity in this type of environment, because very clearly it's going to be a very challenging environment in 2022.
So I can see that although very challenging, you are optimistic on what flexible approaches in fixed income can deliver.
No, definitely. I mean, listen, right now I've got over 30% of government bonds in the portfolio. All I need is a good sell-off. Then I'll be able basically to honestly, all I need is a good sell-off in the market to be able to re-risk the portfolio and benefit from attractive valuations and post very good performance. I mean, to be really honest, the portfolio right now is positioned for a market sell-off in the first half of next year. We position for that, and if it happens, the fund will be in a really good position to benefit from it and post attractive performance for 2022.
And regarding the reference on how low and negative real rates can support equity markets, do you agree on that?
Yeah, I think we're in. I mean, we've been in a period of financial suppression for the last couple of years, basically. And I think the reason why real rates are so low, it's because of QE. Now, obviously, as QE is being withdrawn, what we could see is real rates becoming less and less negative. Now, I think there's only so much less negative that they can become, and I'm not even sure I'll see again positive real yields in my lifetime, to be honest with you, because that will create massive issues for markets and for governments. But I think it definitely makes sense to expect real yields to increase for 2022 as monetary policy is being tightened.
Yeah. So I don't know if you just want to give us a brief on your optimism on what we could expect for the fixed income, but I really agree with all your views, and hopefully we'll have a very challenging, as you say, next year, but also a profitable one.
No, exactly. I mean, at the end of the day, market weakness creates opportunities, right? You just need to be well positioned for it. That's the main thing. And market timing is not always easy. But if we are right, and if we see a widening in spreads in H1, that will create opportunity to risk at better levels, benefit from more attractive valuations that will then benefit the performance of the portfolio. So yeah, I think definitely 2022 will be more volatile. So I think investors need to be ready for more volatility in the rates market and the credit market, but that creates opportunities.
Yeah, and then really value flexible and active approaches.
Exactly.
So thank you so much. Thank you so much for this conversation. And hopefully we'll meet next year, just to wrap up all the all the perspectives that we have spoke about.
Exactly. Well, thank you again. Thank you for your time and thank you for your questions.
Thank you. Thank you very much.